Maverick traders, welcome out to your currency midweek for January 25th. Corey here with you. As always, a quick reminder, let's make sure to follow your trading plans and let's get to it. So there's just not a ton of changes from last week into this week. We're kind of still in this bear market rally mode, a big ABC style correction. The US dollar stays weak. The yen is choppy. I mean, there's a lot of choppiness in the broader markets and in currencies and so forth. So I don't know that there's one theme that we can kind of hang our hat on, but I have been watching for the traditional Bollinger Band pattern setup that I've taught before. It's a system that I came up with years ago, and it's given a couple of triggers, and they seem to be working, which it can work in both a trending market as well as kind of a slow grindy market because you're buying it overbought or you're buying it oversold conditions in an uptrend or shorting in overbought conditions in a downtrend. And so even if you do end up going into a range, you kind of have the right entry point where you're getting in at the bottom of the range. There's just not a ton of follow through, and that's more of kind of what we've been seeing overall. So we're going to look at quite a few charts here today and just kind of explore a couple of things that way. As we look at economic data in Europe, German PPI beat expectations. Anything above 50 on the PMIs shows growth. Anything sub 50 shows contraction. And so the German number went back, just ticked back above 50, which is kind of a good thing. Services PMI here in the US below 50. CPI numbers came in hot in Australia and New Zealand, 1.9 versus 1.6 expected, 1.4 versus 1.3 expected. That does have the markets wondering if the RBA, the RBNZ, if they're going to raise rates, a little more aggressively, if this is going to have those central banks on guard for maybe needing to move more aggressive and such. You did see the currencies trade fairly well, I would say, on this and kind of leading up to that. And then the Bank of Canada kept rates unchanged. Canada is a risk-on currency, but it really, where I would say the Aussie and the Kiwi trade more together in tandem oftentimes, the CAD does move to the beat of its own drum. It's just in a different part of the world, has different circumstances, different risks and rewards, different makeup that way. So let's take a look at performance this week. Just not a lot going on, like I said. Volatility-wise, the S&P is up just slightly, but basically flat. Crypto has only moved 1%. 1% move in crypto is like nothing. It can do that in seconds. Gold up 0.5%, oil down 1%. There's not a whole lot happening that way. The movement this week really comes from one thing and one thing only, I would say, and that's the Australian dollar, which is having a nice run higher. But ultimately, let's take a look at a few different things and kind of make sense of it. So last week when we met, the market was in a slide, and I said, at the time, look, I think it's going to go up and through that trend line. I think that's the max pain. I think people that are kind of betting against this and shorting and so on, they're going to be left disappointed. And sure enough, we spiked back up, made a new high. Now we're doing the same thing over again today. They're trying to beat it back. They're trying to knock it down. And notice how we're bouncing off of the lows. I suspect there's still that upward push. When do you want to bet against this market? When basically everyone else gives up on betting against the market. That's my viewpoint. It's kind of at the point where we call it an exhaustion, or in market terms, they call it a capitulation. What does that mean? Well, you basically just capitulate. You just throw in the towel. You had too much pain, right? And so that's the point where as this market spikes, there should be kind of a finishing touch on it, right? And so we ram higher, and then at the tail end of this kind of steep advance that happens over the process of a few days, you get this big explosive candle, and it just shows that everyone short has just said enough's enough. I quit. I give up. I can't take the pain anymore. And from that point, you'll basically want to get short, because that is the final buyers. That is when buying pressure truly runs out. And why? Because the final buyers on this advance are going to be those that are holding their short positions and just hoping and praying that it doesn't inflict too much pain. And they're going to be the last ones out, and it's going to be explosive, generally speaking, right? The same way that this flushed out the final sellers. Anyone that was willing to sell basically gave up hope. Markets gapped down and they said, enough's enough, too much pain, I can't take it anymore. And that was the final downturn, right? That's where sellers gave up. You're going to see something similar to that, but in reverse, where we ramp higher and then have that capitulation, that exhaustion move. That's my thesis, and I don't see anything here that, obviously it's choppy right now, but I don't see anything that really tells me that's not going to play out. I still suspect we're going to get that spike, and on that spike you will want to get short, but that's down the road. So there's only one thing, again, that's really moving, and that's the Aussie, which, as you looked at the CPI data, the Kiwi, so New Zealand's was a little higher, but Australia's was markedly higher. It was more above expected numbers, and then it was just a bigger number overall. So that certainly gave the markets pause and sent the Aussie spiking higher. But, again, that's kind of everything else is flat on the week. That was very much news specific in the case of the Aussie. I've been suggesting risk on makes sense, right? Because we think that equities are going to go up. We think we're going to spike above that. So hopefully your risk on in the Aussie. That would be the best one to be in this week, no doubt. Ethereum down, Cardano down about 5-ish%. But again, crypto pretty much sideways. Now, let's take a look at a few other charts here. So if we were looking at the markets from the short term, we're above the 20, we're above the 50, and the slope on those is starting to actually turn upward. So just from a technical perspective, this might even be moving more to the green. So, I've been calling for a market rally when it wasn't so obvious. Now it's getting more obvious, and that kind of leads me, again, I think this is how bear markets work, is they're not so much technical as they're very frustrating. About the time that it finally looks like everything's lined up and perfect and the bull is back intact, that's about the time where it's a false gold, right? It's fool's gold. It's not going to be reality. So I don't think the market's out of the woods by any means, but ultimately is improving on a technical basis. By the way, international equities have vastly outperformed. As you can see by this chart, we had cleared the downtrend line previously, and we continue to march higher. The moving averages all starting to kind of conform, the 20 and 50 getting above the 200 and so on. International stocks do look a lot better, and I would expect to really outperform. They're more of what we call the value area of the market, whereas the S&P has a lot of growth area. And I think in today's market, you want to be more in the value space than in the high flyer space. So last but not least, crypto, we've talked about, you got to give credit where credit is due. This thing it broke out and it's sustaining. That surprises me, no question. First of all, I didn't buy into this. I didn't short it either, but I didn't buy into it. I thought it would probably fail ultimately and continue to kind of bleed lower. And I wouldn't have expected this breakout to have the momentum that it's had. Again, I'm not rushing out to buy, but ultimately I wouldn't buy this on a breakout anyway. If I were going to trade it, I would buy pullbacks, not breakouts. Why? You have massive amounts of overhead supply, right? One of my rules is if you got a lot of overhead supply, dead bodies here, no thank you. Breakouts are probably not going to have as much momentum as they could have if there wasn't all that overhead supply. So I'd be more of a buyer of the dip. And admittedly, again, I got this one wrong because I would not have expected crypto to be as strong as it has been over the past couple of weeks. Did I expect risk on? Yeah, but I would have expected crypto to kind of, it was such a big part of why we dropped. It was an area where there were some bubbles and, craziness in coins and NFTs and all these sorts of things, was right in kind of the crosshairs. So you do get these spikes up. I'm just surprised it's had as much upside as it has. I would not have anticipated that at all. Let's look at the rest of this week. So we get advanced GDP coming out tomorrow. A lot of people wondering, again, if we're moving into a recession. Now, the data is not there yet, but the question is more is what is the future data going to show about what's happening today? I don't think we're in a recession right here, right now. Do I think we're going into a recession later this year? Yes. Now, the word recession really scares people. But understand, a recession is just a slowdown. You don't panic because, say that growth went from 4% to 2%. You don't panic because that happened. So why do we panic if what's the difference really between printing 0.5% and negative 0.5? Well, it's 1% difference. It's not like the whole economy crashes and people lose their jobs and everybody, nobody's willing to spend and, the entire market crumbles. That's not how it works. Just because you print some negative numbers for a period of time, well, you might be in a recession, but that doesn't make it a catastrophe, a collapse. It's not the end of the world. So let's be realistic about this. Do I think we're going towards a recession? Yes. Do I think it's going to be some massive, dramatic recession? Probably not. I think the better guess, in my opinion, is that we have a few years of just suboptimal growth, and we've got to work off our dependency for easy money. We've got to readjust to higher interest rates because we spent multiple years at basically a zero rate policy, and they're not going back there in my view. So we've got to adjust to a new normal. We've got to it's like a drug addict, right? We got addicted to the Fed's drugs, and now we're in rehab, and we're going to have some good days and some bad days, and we're going to work our way through it, but it's going to be an ugly couple of years as we get things back under control. So that's kind of how I view the market. Core PCE price index comes out on Friday, and again, that's an inflation gauge. So markets are kind of, I would say, more hopeful that inflation continues to trend in the right direction, which is lower. All right, I wanted to look at quite a few different charts, and if anyone has anything, yeah, the Fed selling drugs, well, they were sort of, because they were selling a lot of bonds, right? But they were buying bonds right along with it. So they were just dabbling in the drugs and kind of getting the market addicted to them. And now the market acts a little bit like an addict. They want the Fed to cut rates. They want the Fed to do this because that's what they've been accustomed to, right? So I don't know. It's maybe not the nicest analogy, but it's one that sometimes those analogies that kind of hit hard are easier to remember and are an important reminder that way. So maybe the better term would be, we got addicted to steroids. That's probably a better way of putting it. It's not it's not it's not cocaine or something. It's just steroids. We got addicted to steroids, and now we got to learn how to hit without the steroids. All right, so a couple of things. A reminder of what this system entails. Basically, you have Bollinger Bands. You got an upper band and a lower band, and those are two standard deviations away from the average. And the average is the 20-period SMA, which is this red line. So you'll notice that the red line is always smack dab in the middle of the two purple lines. Sometimes the two purple lines are tight together, but the red line's right and smack dab in the middle. Sometimes they're far apart, but again, the red line is smack dab in the middle because it's the average. The average will always be right in the middle, and then this is +2, and this is -2 standard deviations. Now, we use the 50 as an overlay, and let me change the color on the 50 just so it stands out a little bit more. Let's go into our studies here. Let's grab the 50 and let's change that color to maybe a brighter blue or something like that. Okay. So the 50 we put on the chart, and this is what we call our trend indicator, right? When you're above the 50, you're bullish. So this would be a time where we'd be looking for some bullish trade. And when you get below the 50, you're bearish, and this would be a time we'd be looking for more of a bearish trade, right? So that's kind of the idea behind it. We're within a whisper of kind of getting towards the upper Bollinger Band. Assuming you're still below the 50, if we get up there and touch that upper band, that would be the essence of our system, which is, let me explain it this way. When I first developed this system, I sat down and I really thought about, like, what do I want? Well, I want to trade with the trend. So that's where the 50-day moving average came from, right? 50 period moving average, because you can use this on a weekly time frame, an intraday time frame. It's just a 50 period moving average, and that's the trend. Above bullish, below bearish. That's my trend indicator. Next, I said, well, I want to buy or sell at great prices. And we know the old adage, you want to buy low and you want to be able to sell high, don't you? So when I'm buying, I want to get as low a price as possible, but working with the trend. And when I'm shorting, I want to get as high a price as possible, but working with the trend. And that's where the Bollinger Bands came in, right? And so the B bands tell us the two standard deviations. And so if we hit the band, I know that we're two standard deviations away from the average, kind of at a good price for buying low or selling high. But only, and this is so critical, only when these two work together. They're a team. And what you'll notice is most of the time, the touches of the Bollinger Band are exactly opposite, right? We do not want to buy here because it's not in an uptrend. We do not want to short here because it's not in a downtrend, okay? We want to use this working with the trend. And so most of the touches, no, it's below the 50. No, 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 no. We're not buying, we're not buying, we're not buying, we're not buying. We're not buying because all of those happen below the 50. We're willing to short at this upper Bollinger Band if it stays below the 50. So most of the signals you get, most of the touches of the Bollinger Bands are just ignored. They don't meet the criteria at all. And that's the biggest mistake I see people make is they'll be like, well, I bought it because it hit the lower band. And I'll look at the chart and go, it's so far below the 50. What are you using for trend? What made you think it was going to stop there? Because what normally happens, if you think about an uptrend, and these are your bands, if you're in an uptrend, what are you going to hit most often? You're going to keep hitting that upper band. I call it riding the band higher. And if you're in a downtrend, you're going to hit the lower band often, right? Just ride the band lower and lower and lower. The rare circumstance is the good one. The rare circumstance is to get to the upper Bollinger Band but still be in a downtrend, or to get to the lower Bollinger Band and still be in an uptrend. That's the rare circumstance, and that presents the opportunity. Harder to find, but better criteria. So again, the Bollinger Band we use on any time frame at all. Now, I don't take every single trade. I look at some other factors and whatnot, but here would be a prime example of a trade setup that anyone can kind of spot and recognize if they follow the criteria in practice. Were we above the 50 MA, the blue line? Yes. Did we hit the lower Bollinger Band? Yes. So this would be the essence of the buy setup. It had the criteria to signal an upward push, and since that time we've gone from 87 to 80, we've gone 100 pips and whatever higher. Now that's on the daily chart. Just because something's happening on the daily chart doesn't mean that you're guaranteed to have supportive price action on the 4-hour or on the 1-hour or whatever. But you can look for this setup on a variety of different time periods. In fact, look right there. Did you hit the lower band and stay above the 50? Well, you just barely. You actually wicked below the 50, but you never closed below it. So that's fine. That meets criteria. You could be a buyer there, and sure enough, nice push to the upside. You could have got a buy signal here, and by the way, this one would have stopped you out. So it's not perfect. That would be an example of a stop loss that would have been triggered, and you'd be out at a loss. Here, a fantastic reward, but we'll take that. I mean, great trade and a stop out. Those things happen, 1 for 2, but hopefully your reward on this one more than made up for a small loss on that one. Here was basically a short setup, right? We never closed above the 50. We touched it. We even wicked through it. We never closed above it. We were hitting the upper band. That would be a short. You're hitting the upper band. You stayed below the 50, and a nice trade to the downside. That's on the hourly chart. So any chart you pull up, I've noticed, good setups, good criteria. As a kind of click around a little bit, here's an example of one that would not. Now, it would have worked for a huge profit, but I wouldn't have taken it because it closed below the 50. Once it closes below the 50, I just kind of have to say, well, not acting quite right, right? Not acting quite right. I'll go ahead and pass on that. And, there's plenty of that kind of takes place where you kind of look at it and you say, well, if we zoom in here, we close below it. That's a deal breaker. We'll just move on to something else. Euro CAD was requested. Okay, let's go click on it. So here's Euro CAD. Let me spread out a little bit. Based on the Bollinger Band system, this does not meet criteria quite clearly because you're below the 50. Here, this is a short. This one would have triggered. We stayed below the 50, never closed below it, hit the upper band, that signaled short, and sure enough, over the next 5 hours, you should have been somewhat successful with that. I don't know how much you made, but certainly worked in your favor for a few hours to the tune of 50 pips or something. But that's a short setup. It's also a crazy squeeze. Look at how tight those bands were together. So see how tight those Bollinger Bands were? That the tightness or the width of the bands speaks to volatility. It's like volatility is noted in these Bollinger Bands. When there's little to no volatility, the asset will go like this, which causes the bands to contract around the asset, right? They're just 2 standard deviations away from the average, and if the average just starts getting low, no real change, you get a lot of periods like this where there's no price change. It causes those bands to squeeze. Now, when prices move violently, the bands will expand away. Look at the price explode here in EuroCAD, and look at the bands expand away. So we have an example of a Bollinger Band squeeze back here, and then obviously right now the bands are completely stretched. Now this is going to lead you to no real setup. Of course you're not shorting it because it's not below its 50 period MA. You're not buying it either because it's nowhere near the lower band. So it doesn't meet this criteria. Now, that's not to say it doesn't meet other reasons for you to take the trade. This is just one system that you can look for that works well in certain environments, and it's just one possible system. EuroCAD is not going to trigger on the Bollinger Band system on the hourly chart for quite a long time, if it does at all. But maybe there's other reasons to trade. Maybe you're going to play this, it broke out, and you're going to buy on the pullback and just play it as a bull pullback buy setup. There's other systems, other approaches, but according to this one, it's just not going to have anything. Yeah, let's look at a few other charts just for the sake of, forget about the Bollinger Band. Let's just look at some other setups. Aussie CAD we had a request for. So this one, let's again kind of zoom out a bit, but Aussie CAD's been trending higher on, this is an hourly chart, but you can see, kind of where all the momentum started back in here, right? This was really your breakout, your retest, accelerated. I would just make a side note, it did give a Bollinger Band setup right there. See how it stayed above the 50, but hit the lower band. And that would have been an excellent, excellent trade. But you could have bought there for other reasons. And by the way, there should be multiple reasons to do something. It's kind of, we want to weigh the evidence, and we know it when we see it type of thing. And so some of these setups you'll ignore. Some of them will really meet your expectations. And I always say that I like setups within a setup. So if I have multiple reasons, if I have the Bollinger Band setup and I'm retesting the prior breakout zone and I feel like this is a cup and handle, so if I can kind of paint a picture where there's a lot of reasons that demand should step in here and drive that price higher, boy, what a great setup, and that one really was. That had multiple reasons, I think, to be a buyer in here. Yesterday was that setup on the hourly time frame. So still working its way higher, barring a sign of exhaustion. So what would be the biggest sign of exhaustion? If you get one of these that happens after an extended run, let's paint a picture where this thing just explodes higher here, and then you get a huge bullish candle way up in the air, overextended and so on. This trade is done. Cash in, lock in your profits. In fact, here's exactly what I'm talking about. See how it ramps and then it explodes at the tail end? You want to cash in your chips. That's my viewpoint. So I don't know when or where this will happen, but if it happens, a la back here, you want to take your profits. And boy, are you glad as this thing kind of fell apart. So if you get a big final exhaustive surge and a huge bullish candle, way up there in the air, I think it would make sense to take that money off the table. Should the Aussie in general benefit from the China reopening? Yeah, that is a bright spot of kind of trade with China, and China reopening is bullish. That's part of what's kind of fueling this risk-on move. So certainly is beneficial on the fundamental side, I would agree. Well, I hope that was helpful, talking a little bit more about technicals and about things that way. So let's come back and think about the rest of this week. We've got GDP tomorrow. On the schedule, we're going to have a couple of recordings. We'll have how to pick your trading time frame. We'll have our recap tomorrow, which will talk about the GDP numbers and what that did for markets. And then the trading room, as always, will come out this weekend. Have a great rest of your week, and we'll be back next week, same time, same place. Goodbye, everyone.